Today we have Marina and Nick Davidov, co-founders and managing partners of DVC. Welcome, Marina and Nick. Good to see you.
Hi, thank you. Thank you so much for having us.
Good morning or good day.
Where are you joining from?
We're in Los Altos, California.
Okay. All right. Tell us a bit about yourselves, your backgrounds, as well as what you're doing with your fund.
So Marina and I are like a husband and wife couple running a venture capital firm, and we've been working together for the last 18 years. Multiple startups, multiple funds, so changing sides of the table quite often.
And what kind of startups have you been active in? What is the background?
So that one thing that we are very constant is our thesis, and doesn't matter is it startups or funds. We've been investing and doing AI for the last, I believe, 12 years.
Yeah. So last 12 years, AI startups, like funds investing exclusively in AI. So yeah, we haven't converted from crypto last year. Yeah, it's not us.
All right. So let's double click down on that. What is your AI investment thesis?
So, you mean quick background. So we started. We fell in love with the technology about 12 years ago. We were big investors in advertising technology, and that was one of the first real life applications of machine learning. And we basically try to find a way for companies to figure out who their target audience is to target them better, because truth is 90% of companies don't know which customers are their target customers, and everybody expects them to know. Like Google advertising or Facebook always starts with like, explain who you want to target, assuming that they know, which they don't. And I don't know who my target audience is. I can only assume that. But if we collect as much data as possible and like throw it all in a machine learning pipeline, we can expect a machine to figure out which links and which dependencies are more relevant and which are less relevant, and then figure out, and maybe my target audience are people with red hair. And I would never think about it. So we started experimenting with that. Some of our products were incredibly successful. And then we just realized how much potential that gives. And the potential comes from ability to boost human productivity, labor productivity, by connecting computers to every single part of human society, of human civilization. So initially we thought that maybe the best way to connect it would be computer vision, to make computers see the world, because the world is so complex, and our visual cortex is so much bigger than our audio cortex. However, what we now know is that since we as humans have described every single part of human civilization by using language, we can use language as a great medium and a universal API, we may call it that way, for every part of human civilization. So we can use artificial computation to boost our own productivity in everything. So our thesis is application layer. We do believe that foundational technology is, of course, very important and very valuable, but it's a high risk, high return, high capital intensity investment, whereas we like to invest in something where you can do a lot with very little, and that is usually application layer.
And what is the size of your fund?
So we have two funds. One is 40 million in committed capital, and it's doing pre-seed and seed, and it's backed by 165 LPs who are themselves engineers and founders in Silicon Valley. And our second fund is 75 million in size and is doing Series A.
Okay. And you are based in Los Altos, California, which is in the heart of Silicon Valley. What is your geographical radius of investment?
As far as I can see out of the window.
Yeah?
Yeah, there's definitely enough startups in the neighborhood.
So you invest only in the Bay Area?
Yeah,
Mostly.
most 90%. We do have a little bit of London, a little bit of Cyprus, a little bit of Portugal, but 90% is here.
Largely here. Okay.
Yeah, but
And
and we also invest mostly in repeat founders because we also believe that in a very changing environment, your experience and background matter a lot. And you have to understand that you have to try hypotheses very quickly, probably pivot a lot. And repeat founders usually do have this experience.
you are not the only people who only invest in repeat founders. The bulk of the venture capital industry invests only in repeat founders.
Well, they
So
try
it's
to.
it's always very hard for the first-time founders. We help a lot of us first-time founders. It's really hard for first-time founders to raise money as a result of that. So I'm going to double-click down on your AI investment thesis and start asking some more specific questions. Let's start with a question that is floating around in the LinkedIn has become the water cooler of the world, right, these days. So you get a lot of the pulse of what questions people are asking through LinkedIn. One of the questions that came up the other day, and I was thinking about it, and a lot of investors who've come here have said this, that, oh, we don't like to invest in wrappers on top of ChatGPT or Gemini or whatever, whichever LLM they choose to have on the back end. Now, there is truth to that. There's reason for that. There is, primarily defensibility reasons. Primarily, what is your moat? How do you differentiate long term after the first wave of customer adoption is done, and lots of competitors come into the market because it is easy to launch something. What is your perspective on this? And I will caveat this question by offering you an example that is a huge and hugely prominent success story of recent times. It's Lovable. Lovable is a wrapper around ChatGPT, and Lovable has built a very fast growth, extremely impressive company, $100 million in about 8 months, I think. And they do vibe coding tools, right? They do really no code application development, and it has lots of competitors. There are tons of competitors in that space. Recently, there's been another acquisition in that space. Base 44, solo entrepreneur, was doing a similar product that got acquired by Wix 6 months into the game for $80 million. So it's a very active space, but it's a good example. It's not the only example. It's a good example to kind of make our discussion visceral for people who are listening. So let me hear your thoughts on how you are thinking about.
So a wrapper has become, and just to touch on your first comment, I think LinkedIn is really like a water cooler of the world, but the problem is that this water cooler is in maybe procurement department or like an accounting department. It's not the C-level floor. And it usually, the news is like late by 3 weeks.
That's not true at all. That's not true at all. I don't know whom you follow and what you follow, but the entrepreneurs are on LinkedIn in droves.
Twitter's number like one and like where things happen. But yeah,
I don't agree with you at all actually on that.
But yeah, so wrapper is a derogatory term that is used for application layer startups. But if you think about it, ChatGPT is a wrapper of NVIDIA, and NVIDIA is a wrapper of TSMC, and TSMC is a wrapper of silicon. Same as Amazon S3 is a wrapper, like Dropbox is a wrapper of Amazon S3, and Amazon S3 is a wrapper of, again, storage and cloud. So it's just a wrapper, really, what I call a wrapper, is when you take ChatGPT API and make it available through, let's say, Telegram chatbot. And maybe you throw in a couple more APIs there, and there's no UI, no value. Think of large language models and foundational models in general as operating systems that people have to interact using a terminal, which is not a very good UI. And if you have built an experience on top of that then it's no longer a wrapper. It is an app, same as, an app in the operating system. One of our most successful investments, Perplexity AI, has been called a wrapper numerous times. But look at them. They have their own search. They have their own models that are used for search and presenting the information. They still rely on large models that are using reasoning and stuff from like others, but it also is their incredible advantage that like no matter like Grok or Claude or like GPT-5 is the best today, you can choose it through Perplexity to use vision.
That's a very good example to double click down on. Let's do that. What do you think is the secret of Perplexity's success? What is the profile of the customer who's using or user who's using Perplexity?
So it's mostly a knowledge worker who is working with information retrieval and analysis most of the time. And from there, it penetrates other parts of their life. And for me, Comet, the browser, and Perplexity itself has become irreplaceable. There's a very good test. It's like, how much money would your users pay you not to take your service away? And I think back when Perplexity just released their search, my number was $2,000 a month. That much I was ready to pay not to lose access to Perplexity. And that was why we very strong believers. Now, the secret of success is that Arvind and the team, they focus on things that don't change. In the environment where everything changes every week, and in the last 2 weeks we had more progress than in the last 2 months, and in the last 2 months we had more progress than in the last 2 years, and 2 years more than like 20 years. And the only way to persevere through times like this is focus on things that are not going to change. Users are not going to look for a slower product, a product that is less accurate, a product that is less enjoyable in the experience. So you focus on quality of the execution and speed of shipping things that work. And then strategy-wise, they're doing very good moves because we all understood that prompt engineering is very important for large language models to get you good results, right? But then what Perplexity understood, and probably they understood it the earliest, is that it's not about prompt engineering, it's about context engineering. The context that is presented to the large language model vastly determines its output and output quality and usefulness of it. So if you present it with more relevant context, giving it might come from search, and having a search that is better than Google for LLMs is very important there. But also it comes from the user creating this context, and it's not great to just expect users to provide like 2-3 pages of context in the prompt. But what you can expect is that if a user is using your browser, and if a user has an app, then you know which sites the user has seen, you know which logins they logged into, like you know what's in their LinkedIn account because they're logged into LinkedIn with the browser. You can do things there, and you can use these things to provide better responses, not to target ads for the user, but to understand what they actually need. So when I say, hey, get me another tuna bowl, it knows what tuna bowl, which restaurant, and which delivery service I'm talking about, and like how to pay for it. And it's like what it does, it just sends me the tuna bowl.
All right, let's change. I think if I were to summarize for people who are listening and maybe are not as far along in following what you are saying, there is, and Perplexity is not the only LLM that is offering this. I've seen it elsewhere as well. There is a lot. This is a very useful feature, which is related questions, and this talks to your point about prompt engineering and context engineering. When you start working with Perplexity and start asking questions, it's going to give you a lot of related questions, and that's very helpful. in navigating. You don't have to design all the prompts yourself. You're basically prompted for prompts, and that's helpful. That's productive. I think you're saying that this is not something everybody else is doing, but is it that difficult for everybody else in the LLM world to do?
Not that difficult. It's very difficult to do it right. It's very difficult to do it like with the speed that they're doing, and so with the quality. It was like if you notice, if you take a look, every time there's a new model released, let's say a new open weights model appears on the market, and it's just the paper is 3 hours old.
Mm-hmm.
Perplexity already has it built in, and their time to first token is incredible. So like the way they host models, the way they do everything, it's just like unreachable for the majority of companies. It's like, so that just focus on shipping, focus on two things: create the most enjoyable possible experience for users and make it the fastest, the most like highest quality, highest accuracy, robustness, technology and business.
So let's come back to the wrapper question. You started off by saying Perplexity is a wrapper on top of other LLMs and so on. So we went down the Perplexity path. Perplexity is a very high capital intensity product to build.
It is not. It is not.
Okay.
It is very lean. It is very lean. So if you compare how much money they raised, and like they haven't spent much of it, they still have the majority of the money they raised in the bank account. That's their superpower. So OpenAI has to spend $200 million to train a new generation of a model, but it's like Hollywood blockbuster business. You have a chance that your movie is going to score at the box office, but the odds are it's not. And even if it does, it's going to be around for like 2-3 months, and then like a new movie is going to come out, and everybody else is going to go see the new movie. And the problem with that is that they need to get to a scale where they can distribute it and recoup the investment in like 2-3 months. While Perplexity enjoys very lean, like they don't burn money on compute for training models. They don't burn, like it's minimal. They don't burn money on anything other than basically what users directly pay them for. Plus they are closer to the users, so they can like get more. The rule of thumb in business has always been be closer to your user, be there like your user's first screen, and you will control where user is directing the money flow.
So then here's another question, related question, and this has also come up in the context of this new Lovable funding. Lovable has just raised a huge amount of money. It didn't need to raise any of that money. It was doing great. It was, growing really fast. Pardon?
I mean, like, was it?
It seems like it.
But have you, like, I don't know what their profit margin is. You see, the problem with coding is that the majority of players in vibe coding are negative margin.
But this is a paid product. This is not a free product.
Yes, it is not a free product, but the problem with subscription-based products is that you have users that burn way more tokens than you get paid for.
Well, but that's a pricing model question, right? If you do a pricing model that covers your costs and creates
I think Lovable is a great company. Like,
if you're destroying your unit economics, that's your problem. That is not,
But
going
take a look
into
at
business
Cursor.
by destroying your unit economics is no way to do business.
But take a look at Cursor or Windsurf. All of them negative margin.
So I think this is a very good question, very good point that we have arrived at organically in this discussion, which I think users should, the audience finds value in that Silicon Valley has always had this disease of poor unit economics businesses that are, venture capital subsidized, like we call it venture welfare kind of. Why would you do that? And why do you expect to build a sustainable company in this mode?
It's land grab. You're always looking for openings in the market that can utilize to penetrate it. And then once you pass a certain threshold, the general belief is that you'll be able to use all of the momentum, brand power, distribution that you gained, and money that you raised to actually secure like a healthier. Uber is a great example.
I don't believe
Amazon has been losing money for like 25 years of its history. Look at Amazon.
But Amazon has never worked on flawed unit economics. Never.
Amazon has been losing money for 25 years.
It has been losing money, but that is because it has bought growth. It has not operated on flawed unit economics ever.
That is like, where do you draw a line? Where's buying growth versus flawed unit economics?
Okay, so this is not where I want to go with this conversation. It's 8:22 a.m. I only have another 8 minutes to work with you. So let's actually.
I think that's a pretty important topic for founders. It's like, how do you decide like whether you subsidize
it is an important topic, very important topic, and it is something that, so in 1Mby1M we operate with a philosophy of bootstrap first, raise money later, and preserve profitable unit economics all along. Otherwise, you would not be able to bootstrap. And why? Because of what you said when you came into this call to start with, is that you don't invest in, except for repeat founders, you don't invest in first-time founders. Our audience is largely first-time founders. And these first-time founders have nowhere to go other than bootstrapping and building sustainably and then getting to success, and then they can attract money. They can attract money with a solid business. They cannot necessarily attract money up front.
You see, the funny part is that the definition of a repeat VC-backed founder is that they have raised VC money before. So they have raised the first check, being like first-time founders. And I raised my first check when I was a first-time founder, and Marina raised her check when she was a first-time founder. It doesn't mean that they have to be bootstrapped. There's the majority of VC funds invest in first-time founders. It's just maybe they're not ready. Maybe they're like the company is not ready.
Yeah. So how do you get ready? To get ready, you have to validate your business and get to readiness.
But you don't need $1 million ARR to raise VC money.
A lot of VC funds do ask for $1 million ARR before they write a check.
But again, you should raise from angels, not from funds, like from smaller things. This is if you go and talk to investors.
Anyway, we've been doing this for 15 years. This is a world that I know very well. And we work with very large numbers of founders, and a vast majority of them are not ready to raise capital. So they have to somehow put one foot before the other and make progress and get to fundability. Our world is full of people who are not fundable. And they have to be taught how, or they have to be somehow given the tools with which to they can move one foot before the other. But I actually have a much more interesting question to explore with you, which is, we talked about Perplexity as a wrapper. Give me examples of other interesting wrapper companies. I think these wrapper companies are actually very easy to bootstrap and very, very desirable for people to build, revenue on top of very quickly. So give me more examples of what you're seeing.
So we have 125 portfolio companies, out of which 72 are agentic businesses, which you might call a wrapper.
Okay.
So we can name all of them, but the problem is that it's not easy to build them. It's not easier. It's just a different business from building a foundational model from scratch, and I don't think people need to build more foundational models because it's just a commodity.
I don't think we need more foundational models. I think that's done. That's happening.
Oh yeah, it's like we're building a car and we're gonna make our own oil. But with great niche products that are not expensive to kickstart. We just announced the round of Key, which is software for due diligence. So private equity funds do a lot of due diligence when they buy companies. Mm-hmm. They have a similar set of questions, and the guys have created a beautifully designed agentic system, plus a little bit of like data room software It took them roughly 3 months to get to 3 million in ARR.
Wow.
And they went through Y Combinator and raised a beautiful 5 million seed round after that. Solve Intelligence is a beautiful agent that is building solutions for patent attorneys. So it like agents that write patents for you out of technical documentation. They are doing pretty incredible. Fleetworks is a company that uses agents to schedule freight dispatchers. So it calls drivers, negotiates with them, gets them to take like payload from point A to point B. Avoca AI is another incredible breakout success from our portfolio. They do like AI salesperson / CRM for contractors, people who install like, electricians, people who install HVAC equipment. They don't have time to pick up their phone. They don't have time to speak to customers. So like AI does that for them and just like puts the appointments on their calendar and tells them what to bring. It is really, really cool. They're incredibly successful. Kick.co is AI bookkeeper company that Marina and I used for the last 2 years to file our own taxes. They're growing incredibly well. Eloquent AI.
Let me ask you a question. In the ones that you are seeing really, taking off, if you put them in 2 buckets, one is PLG, product-led growth, which in the case of the companies like Lovable and Base44, that has been really the driver. And I suspect some of your companies in this pool of 72 are probably following that path.
Yeah, including Perplexity, yeah.
Including Perplexity. And then there is also, enterprise applications. I suspect the private equity one is more of a it's not exactly product-led growth. There is a sales cycle attached to it.
There's always an element of both, but yes, sometimes it's I think for our fund it's 50-50, where like the 50% is the majority product-led growth and 50% is like you take it and you sell it. And but a lot of times, once you start selling something that people love, like if you sell something to HR people, they all talk to each other. If you sell something to IT people, they all talk to each other. So like there is some element of product-led growth there.
Some element of word of mouth, yes. Yeah. Now, to the extent that you have adoption inside of enterprises or businesses, let's say, what are you seeing? Are you seeing human in the loop or are you seeing human replacement?
You want to take this?
Yeah, we've seen both, but in terms of enterprises, it's very important to understand that we see a lot of growth in sales for like startups because enterprises are pushed to actually implement AI right now. The problem is most of the time it's done not from the budget that is like long term. It's a pilot. It's a pilot. It's experiment budget. So we can see that yes, a lot of enterprises start using AI agents, AI in like different tools, but probably it's not long lasting. And it's misleading for entrepreneurs most of the time because they like calculate it in the IRR and show as a growth, as a steady growth.
And how does that inform your investment thesis then?
So we try to disregard pilot revenue if we don't see how it gonna stick. So the problem is like when you look at a company that got like 300K revenue from Netflix, that Netflix just gives 300K to anything that seems valuable to them, just to try it out, because for them that's a rounding error. It's basically zero. And we try to look into the product. We try to find, so usually like one of our LPs would be like a user of the product, and that's how we would actually know about the company, that somebody's like started to using something for like data compliance in their bank, and we're like, oh, okay, we want to talk to the founders. Can you introduce us? So this is how we discover startups most of the time. A lot of times, companies are experimenting with two things. So they experiment with open source and building stuff on their own, and at the same time they would try startups. So they would like run a parallel test. Because it's very hard for management to figure out like whether like their engineers are right, and like they can just open source it and have it run on-prem and not depend on like any other company, or maybe their business is right and like they need to buy it from that fancy startup. And so we have quite a lot of investment in open source technology. And in terms of human in the loop, I'd say there are four categories actually. So it's human doing, AI doing, or human managing, AI managing. And then like this four can intersect in very funny ways. But we have an interesting company called Copilot Kit. They specifically do open source frameworks for humans in the loop. And there are just different kinds of processes where AI can work and replace both management part and work part. And then there are places where it cannot. And usually we have this like three questions that we ask. Anytime we look at a process, even for us, because we build agents for our internal processes, we look at the process and say, okay, first, are there rules that define this process? Because if there are no rules, or it's good to break rules, AI is not going to work. Do we have a single source of truth for this process? Like, do we have a CRM system, and like, or do we have multiple email threads in a spreadsheet and somebody's text message as a single source of truth? Because if that's the case, AI is not going to work. And then the third question is that, do we have an abundance of data that shows input output kind of, so like what goes in and what should come out into human decision? How can AI learn? Because if there is very little data, for example, we cannot automate investment decisions because there's very little data. 125 investment decisions for companies that are quite different from each other, very hard to automate.
Very hard to automate. Yeah. Very good. Last question. Given all these things that we have discussed, when you write a pre-seed check, you said you do pre-seed and seed from one fund and Series A from the other fund. When you do a pre-seed check, what do you want to see in the company?
In the founder. We like a lot of times on pre-seed, there's like the company is just one or two founders and then nothing else, and maybe ideas.
And even if they have like an idea, understanding on the market, we realize that everything can change. The product, how they apply it, but the founders most of the time will stay.
So you're investing in the founder and the founder's track record, and the rest can change.
Not necessarily track record, but like, so what the founder's track record informs us of is what kind of founder market fit they might have. So what markets are they proficient in or passionate about, and how attractive these markets can be. And then second, like we ask three questions. We're like, number three. Would I go and work for this founder? Like, can they hire the best people? Can they raise enough money for the idea they're building? And the third is like, can they actually execute? Do they have the skills or ability to put together a team that can execute? So these are just like three questions. And then Marina has a very important fourth one, is like, what is their really mental state and motivation? Why are they doing this right now? Because a lot of times, especially with repeat founders, you might find somebody who's just doing stuff because they're bored, or because they're angry at the world, because their previous company was a failure and they want to like prove something,
or because they think it's logical based on the experience, like it's a logical move to do that, but they actually do not have passion.
Yeah, but a lot of times you can fall into same problems. It's like, you don't want to invest in a founder that keeps selling their companies for like 20 million after like 2 years or 3 years. because it's going to be another 20 million exit.
So that actually speaks to your investment thesis. There is actually a whole segment of investors who are investing in those kind of companies that are bootstrapping or seed-strapping to exit, and they're doing great. If you look at Carta data, actually, it's the sub 10 million funds that are exiting, that are doing, fast exits, is where huge returns are happening.
That was our previous fund, actually, and the problem is that your returns are distributed like from 1 to 2x. It's like very hard to lose money on that kind of fund, but it's very hard to make any money. And then like a lot of LPs would just look at that and say, hey, yeah, this is amazing, but like I can just buy, like an index fund, and it's gonna outperform.
But for founders, if you can build a company, and especially right now, given what's going on in the market, you can build very lean companies.
That's true.
Very lean, yes.
Super lean companies. Yeah. And if you build a very lean company and exit, you have raised less than $1 million and you exited $20 million. That's a great exit.
So like if you think about it, it's not that great. So let's say three co-founders, and you raised $1 million. So
there's a lot of solo entrepreneurs working in our orbit. There's a tremendous.
Oh, I mean, like solo entrepreneurs. Solo founder
right
selling
now.
For 20 mil is
a very good situation.
It's very hard to sell like a solo founder company to corporation for like 20 mil. It's probably going to be like 10.
Oh, look at Base 44, solo entrepreneur, 6 months, $80 million exit to Wix.
That is a success story. Yeah.
That's a fabulous success story, and that's happening it more and more. Anyway, this is a great conversation. I'm glad you reached out. I'm glad we had you over, and we'll continue the conversation in a few months. And as we learn, as you said, in 2 months, we're making 20 years worth of progress right now. So things are going to change.
Oh, it's going to be crazy. Yeah, like I'm going to have a robot body.
Soon, yes, indeed. All right. Nice to meet you.
Likewise.
Good luck to everybody.